Hi, this is Mark Harrington from markharrington.com. This is the next in a series of videos on investing techniques covering the topic of income strategies using options, and I'm going to talk about covered calls and naked puts. So first of all, a little bit about me. I qualified university with degrees in business science, a law degree, and MBA. I am a chartered management accountant with the UK Institute and the designation of CGMA. I have a 25-year career in management consulting and sold our own consulting business in 1999 to a .com web development company. Year 2000 was not good for us, because in 2001 that company went bankrupt. My investing experiences, I've managed my own technology portfolios since well before 2000. I took over my own portfolios entirely in 2012. I invest in global markets and in a full range of instruments, and about the only thing I don't invest in is property, or I've not had much success in, is investing in property. Now, the context for this discussion is on February 21st this year, the world stock markets collapsed, and in fact, in 5 short days, the US market dropped 37%. The importance of February 21st, it was options expiry day. Now, I learned some hard lessons in 2000 and particularly in 2008. So I'm just going to put up a chart that shows in 2008, from the peak, we had a 57% fall, and the market took, from that peak to the recovery, was 281 weeks to get back. And it was 221 weeks from the bottom. So we divide that by 52, that is 4 long years. So 4 years from the bottom just by holding your portfolio. In my portfolio case, with an outsourced portfolio managed by a fund manager, it took 4 years longer. Now, why did that happen? Is because fund managers are required to keep their funds in balance. So if one stock sells harder than others, they do then sell the ones that have become disproportionate part of the portfolio, and they crystallize the losses. So instead of taking 4 years from the bottom by holding, I took 8 years, because the way the fund manager behaves. So that defined my strategy. So here's a chart also of the S&P 500. There's the drop of 37%. I actually drew this chart. It took 7 days to recover 27%, so it was a net drop of only 15 at that stage. And then we'll go through, it's taken around 6 months. We'll see this peak here is higher than that, and then we've seen a recovery back past there. So it was around 6 months to do the recovery. So my strategy came based on 2008 was to not look at my portfolio at all. I just stopped updating prices. I avoided the news. I stopped watching Bloomberg TV. I just stayed right out, and I did not sell anything. But what I did do is I continued to look for income opportunities using options, and that's what I'm going to talk about. Now, what we've learned, this recovery tells us that this was a different market situation to 2008 and to 2000. It's not a structural thing or something wrong with the market. It's more to do with sentiment in the market and a hit to consumer spending. So it has been a quicker recovery, but recover it did. So before I talk about option strategies, I need to introduce a few options concepts, as you may not all be aware. We're going to use covered calls. Now, a call contract is the right to buy. Easy way to remember is call up. So we're looking for prices to go up. We're also going to use puts. The puts is the right to sell. Easy to remember, we're going to put something down. So we're going to call up and put down. The structure of contracts is one options contract applies to 100 shares normally. That's the normal multiplier, especially in the US markets and in the German markets where I do my trading. The next concept that is important is implied volatility. Now this is the relationship of the options price to the underlying price. When things get more volatile, implied volatility goes up, so options prices move faster than the underlying price. So the first of the strategies we're going to talk about are covered calls. Now it's a fairly simple process. Is we're going to sell an out the money call contract against stock that you already own. We're going to aim for 1% premium for 1 month to expiry. We're going to hope that price does not move above the sold strike price. And if it does, we will deliver the stock. And then if it does not, we'll just write another contract for the following month. So do that by example. If Wells Fargo share price is $50, we have 100 shares. We're going to sell one contract with a strike price of 55. So that's out of the money. And we hold the stock, and we're going to hope that we get 1% premium. We'll aim for 1% premium. We might have to sell a 52.5 strike to get the 1% premium. So that is the normal strategy. My strategy is a little bit different, because the normal strategies, the convention is that you want to look for stocks that are going sideways, because you don't want to deliver stock. You just want to see the things that are going sideways. I might as well earn some income. My approach is I apply this to all the stocks in my portfolio. And what I do as a process is I look for a target price move each month for stocks that I'm holding that I'm already in profit on. I'm looking for a 5% improvement in price, or a target price. For the stocks that I am losing, that I am not profitable on at the time, I look for a 10% movement in price. So basically what I'm saying is, if the market wants to move 5% in a month or 10% in a month, I'm happy to deliver the stock. Now what I do is I vary that a little bit for more volatile stocks. So things like technology stocks, cannabis stocks, lithium stocks, I use 7.5% and 15%, and sometimes 10 and 15% as the target price move. And now I then take whatever premium is available for that target move in price. Now, until February 21st, I was averaging comfortably around that 1% mark. Not always getting 1% on every contract. Some were higher and some were lower. And I delivered the stock if it's get called, and I seldom was buying back. In the early days, I did buy back, but certainly in the last 2 years, I was seldom buying back. So that's the normal process. Now, what changed after those February expiries? Well, implied volatility spiked. And I noticed that for that 5 to 10% movement in price, I was able to get a 3 to 5% premium. So what I did is, rather than just taking that premium, I was looking for a wider target price move. And that, in retrospect, that was a pretty smart move, because instead of, if the market has dropped 30% and you're looking only for a 5% or a 10% price move, you're actually going to be crystallizing losses on the way, on the recovery. So I widened those price moves to 10 to 20%, and mostly we're writing them at 20%. And what I was particularly doing is I was letting the market decide an exit point on the stocks that I was holding. Now that's, finding exit points is always a challenge. So if the market's prepared to move 20% in a 4-week time period, then that feels like the place to exit. It feels like a better place to exit than 20% lower. And then I continued to take whatever premium was available, and I delivered the stock if it was called, and I did do some buybacks. Rather than buying back the contracts though, I just replaced the stock. So I'm going to do a quick case example. I'm going to work off the charts, and I'm going to use Commerzbank. It's listed in Germany, and partly because that's one of the first ones that I was doing all those years ago. So we're talking here in July 2016, June 2016, what I've drawn on this chart here. So this, the start of these arrows is 20 June 2016 is options expiry date. So that's the closing price on the Friday. So the closing price on that Friday is 672. You'll see that up here. This number up here, we'll see that it is, so if I go back a day, 672. So a 5% movement in price would need to add 35 cents. So we're looking at an options strike price of around 710 if I can get it. So that's 5%. That's the little blue arrow. So the point of this blue arrow is 5% higher. So you can see there on the right hand side it says 710. It's 5% higher than that close price there. And then the green arrow is what if we look for 10%. So we're looking at a price of €7.40. So that's the process. Is I'll sell contracts, covered call. I'll sell call contracts for the number of stock that I have, either at that 740. So if I'm losing money, that's what I would have done. Now what I'm going to do is, in this particular case, at the time, as you see, I would have bought the stock somewhere back here, which was higher. I am going to borrow this arrow, and we're going to say what happens next time. I'm going to stick that arrow on the options expiry date on the 27th of July. We have to go to options expiry. It's this blue line here is the next options expiry. So I've now put this 10% move in here. You see the price is finished below that. So I'm going to borrow this one again, and we're going to roll it out again. So closing price was down there somewhere, and we can see here price did actually go above this closing strike. So these two are actually quite similar. And we'll just keep doing this. So this strategy is fairly simple. So you can see here we're still rolling. I'm going to put one more line in here. I'm going to do this 19th of October because we really want to see what happened here and see if I actually had to deliver this stock. And we'll see that at that options expiry date, price has now moved above. So we would have had to deliver the stock. So there's 1 month, 2 months, 3 months, 4 months, 5 months. That's so between 1 and 3%. So 1%, that's 5% income added. And then we've got a price move that in price, in fact, is not much different to where it was over here. But I'm 5% better off because of the income strategies. And then we'll just keep rolling it all the way through. Now I'm going to go and have a look at, we're going to go across to the current situation. Now these arrows here, these are now 20% arrows. So this is the options expiry. And there was a few days delay, so 27th of February. So during the course of that week after that last expiry, 20% here, 20% here, 20% here, 20% here, and I'm still holding the stock. And you can find as we run all the way through there's not once have I had to deliver the stock. So that covers the exploration of the change in strategy of covered calls using Commerzbank as a case example. Now, while I'm looking at this chart highlights an opportunity to use naked puts. Basically, the concept of a naked put is we're going to sell an out-the-money put, so a price that is lower than the current price with 1 month to expiry, and then pocket the premium. And if the price does drop lower than that at expiry, we do have to buy the stock. Now, this chart is a good example. I'm going to draw in an array, and I'm going to start here. So we can see we wouldn't want to be doing it here because we don't know where this bottom is going to be. The bottom is going to arrive. We can see here we've got a bottom. It's bounced up and it's now recovered, and we now have two bottoms. So we can sit here at this expiry. So at this expiry date here, we can see that we've got a level here which has been confirmed. So we can draw an array and say, let's sell a naked put here, somewhere here. I'll make it lower than that low there. So if I can then sell it, so there's a nice round number, 280. So I'm going to pop that down to 280 So we sell the naked put here with 1 month to expiry, and we just hope that price stays above that at expiry, which it has done. And then in case we'll just do it again. You can see we've stayed above, and we can then do it again. So we wouldn't know, we may not find that we can get 1% premium here, so we could take whatever premium we can accept at that level, or we'll just skip a month. And then we can sit there and say, well, now we've got a new structure emerging here. We've got a low here. We've got a higher low. So this expiry, you can sit there and say, let's make one here. So draw that ray in. So this expiry, we're going to make one at this low. We're going to write one at this low. And then progressively, we can work our way across these charts. And ideally, you want to try to say, let's keep it that low. And then we can keep it at those lows, so we can progressively add. While we're collecting the call premium, we can collect premium on naked puts, maybe not every month, but certainly we're basically doubling our income opportunity every second month. So let's just summarize that strategy. Is we sell out the money put, we aim for 1% premium for 1 month to expiry. We in hope that price does not move below the sold strike price, and we just keep doing it over and over, provided a technical analysis in the charts is showing us that it's safe. Now my approach is a little bit differently. I also apply it to stocks that I'm happy to buy. So in the Commerzbank example, I'm happy to double up on the stock that I'm holding because it's averaging down my entry price, but there are other stocks that I'd be interested to buy, but I don't really want to buy at a high price. And so I look for a target entry price at 5 to 10% below the current price. And maybe let's just do it by example of one that I did this week. So I have a recommendation which came in from one of my research houses on Walmart. So here we have Walmart, and the recommendation was to buy Walmart at 145. I think the recommendation, so it came in there. So what I did is that I sold a put at 135 with 1 month to expiry. This earnings date lines up with the expiry date, and I collect the premium. And I'm pretty confident that price is not going to go down there. We've got a beautiful uptrend here. I'm confident that price is not going to drop below. And if it does, I do not mind buying Walmart at 135, because that's the price I could have bought it in September, which is the price that's not been available for 3 months now, for 2 months now. So I'm not uncomfortable buying it at that price. And it's much more comfortable than buying it at the current price. So that is an example. The other example which I've used extensively is stocks that are on a rocket ship. Here's Roku, the TV streaming company, from the bottom. Actually, if we roll it back, we can see where I sold puts. Is that I've seen the structure here. I sold this put for a reasonably short period to expire. Totally comfortable to buy at 95 because there's a price structure there, and price kept moving away. I just keep the premium. And then it's just a question, when you do this expiry here, at what level do you sell them at? Maybe that level there, and you'd see it's the same period to expiry would have been totally comfortable. Would have been caught out over here, but as we look now, what do? Here's a structure here. You can sell them at this level and participate in the rise without committing the capital to the rise. Now, there are some important risk factors we need to take into account here. On covered calls, you're already holding the stock. The risk factor that you've got to manage is that you continue to hold stock that you should actually sell. And the fact that you have a call written against the stock holds you back. And if that situation arises, the smart thing to do is to buy back the call and sell the stock. Or you just got to ride it out. There's no shortage of the stocks in my portfolio that I'm just going to ride it out. And I know, for example, the income that I've earned on Commerzbank far outweighs the capital losses that I made, because I've been writing contracts against that since 2016. That's 4 years now. The next risk factor is we've got to be aware of is that when the upcoming dividend is larger than the call premium. What will happen is on American options is that your call will be exercised and you will be required to deliver the stock because the owner of that call contract wants to grab the dividend, and then you lose out on the dividend. And then the third risk factor is that you're actually required to delivering stock that you should continue to hold. That's easy to deal with, is you just replace the stock. Once you deliver the stock and you just think you need to hold it and you want to hold it, you just buy it again. You will pay a bit more, but you buy it again. On the naked put side is the important risk factors are, the biggest risk here is that price drops really hard. And Boeing, as an example, dropped really hard on the 737 MAX situation and is really struggling to recover that over a long period of time. And then you're caught out having to buy stock at an appreciably higher price than the current price. So there are ways of managing that. You can buy back your call contract, just take your put contract and just take the loss, or you average down. And what I tend to do is I tend to average down and buy into to mitigate the losses. And you also need to have a significant amount of margin in your account to buy the stock. So I just only have one or two of these sitting open at any time. Now that's all very well and good. I'm describing a situation where I have a fairly large portfolio, so I have a large number of stocks. For you to get started and you have an existing portfolio of stock, the smart thing to do is to choose a market where there are liquid options markets. And in my experience that's the United States and or Germany. The next thing to do is to open a low-cost brokerage account so you can get access to these markets. I use Interactive Brokers because they provide low-cost access, especially to US markets. European markets are more expensive, and it's uncomfortable sometimes you're paying a premium, a brokerage fee or commission of 3% when you're only earning 1%, but it's ultimately free money. The third step is to move your target stocks into that account, because you must be able to deliver against the contracts you've sold. So the stocks must be sitting in that account so the broker can deliver stock if they have to. Define your parameters. So I started out with a 5 to 10% rise in price versus the target premium of 1%. In the current market, I'm using 10 to 20% rise in price versus the target, and then you just begin the process and rinse and repeat. So that's if you have an existing portfolio. It's just a question of working all the way through the portfolio and applying the principles. Now, what happens if you do not have an existing portfolio? How do you start? So the first step is we're going to choose a market with liquid options markets, so the US and or Germany. So if we take the US market, we need to open a low-cost brokerage account. Again, I use Interactive Brokers. We're going to buy 100 shares of a stock you would like to own. Now, clearly the value or the price of a stock will determine what you can actually buy. So if you want to buy the index for the S&P 500, it's currently priced at $345. You need to buy 34,500 worth of stock. But an index ETF is a good way because it diversifies your risk, or just buy a cheap enough stock. So let's just have a look at that. I'm going to go across to my list of index stocks. So we're going to whiz down here. So S&P 500, this is one here. There's an ETF called SPY. It's at $356. So to buy 100 shares, you have to buy 35,600. So that's not going to work very well. This European stock here, VGK, it's only at 56.85. So to buy 100 stocks, I can buy 5,680. And here's a different idea. Look, you buy bank stocks. KBE is $37.80, so I only need $3,780 to buy 100 shares. And here's a different idea. GDX is gold mining stocks. I'm going to click on this one. And we can see that gold mining stocks track gold price up to a degree. This is a gold price chart here. You'll see that the shape looks remarkably the same. The beauty about gold mining stocks is it's only $37. There's a reasonably good options market against this, and we can sit there and we can start. So we buy 100 shares of this. That becomes a hedge trade because it's going to move potentially in a different direction to the markets. We can see that it's certainly gone sideways for quite a period of time. Pick that 5% or that 10% target and write calls against that. You can also do naked puts because we can see there's a level here, and you would not be unhappy to buy the stock at a price lower than those. So we define the parameters. 5 to 10% rise in price versus the target percentage premium, or 10 to 20 as I've been doing, and then just begin the process and then rinse and repeat. And progressively, as you get enough capital to buy another 100 shares of a stock that you would like to own, make it different to this one that you've already bought, and add it into the portfolio, and then you now have 2 stocks to write against. And then progressively, when you've got enough capital to buy another 100 shares, you do it again. So appreciate your time. I hope that has been helpful. We've covered a very large range of topics on option strategies for income, writing covered calls, and writing naked puts.